JP Morgan really wasn't lying. Seriously. After New Year's Day, 2026, you really shouldn't be out there playing around. Have you ever wondered why so many people get wiped out every time there's an economic crisis? It's because these things never happen without a warning. It's not like you go to sleep tonight and wake up tomorrow in a total collapse. There are 3 specific pieces of evidence that show up a year or 2 in advance, right in front of your face. And these aren't some top secret data only the president can see. If you turn on the TV or open your phone, the news talks about them day and night. So the question is, does everyone just go blind right before a crash and can't see the data? Or is someone intentionally hiding the data, stalling, or trying to convince you that this time is different? It's like a game of Russian roulette. The gun has 6 chambers and only 1 bullet. 6 people each take a turn pointing it at their head. What happens? The first 3 people pull the trigger. Nothing happens. And they even get a cash prize. Now, you're the 4th person. Do you start thinking, is this time different? Maybe there isn't even a bullet in here. Or are you so desperate for the prize that you think it's worth dying for? If that gun definitely has a bullet in it, and the first 3 guys were fine, doesn't that mean your probability of getting shot got higher? Your odds of getting shot just went from 1 in 6 to 1 in 3? Shouldn't you be the one walking away from the game? The best way to play is for the first guy to get shot, so the rest of you can pull the trigger risk-free. Same logic. The stats show that whenever this specific situation happens, a financial crash follows in 1 to 2 years. Not only has it happened, but a full year has already passed. If you think the bank failures and layoffs last year weren't a big deal, do you really think we're different this time? Or is the probability of a crash this year actually much higher? Hello everyone, I'm Money Zen. Today, if you lend me money, whether for just 1 day or for 10 years, can the interest rate be the same? No way, right? Any normal person knows lending for 10 years is riskier than lending for just 1 day, right? If it's just 1 day, unless I was already planning not to repay and trying to scam you. Otherwise, in just the 1 day, I won't suddenly go bankrupt or lose my job out of nowhere, right? But if you lend it to me for 10 years, that's completely different. Way too many things can happen in 10 years. Even if my business stays great for the whole 10 years, and I still have money to pay you back, I myself might change after 10 years. I might deliberately decide not to pay you back, right? So the longer you lend me money, the higher interest you should charge, right? From another angle, when you lend me money, you're basically freezing your cash, right? The longer it's frozen, the more compensation I should give you, the more interest I should pay, right? That's why long-term interest rates are always higher than short-term rates. But here's the problem. Historically, in the US, there have been many times when long-term rates were actually lower than short-term rates. Like, I borrow from you for 10 years and only pay 4% interest, but borrow for 1 year and have to pay 5%. From the borrower's perspective, wouldn't I want to borrow as long as possible? And from the lender's perspective, wouldn't you prefer shorter terms? This is called a yield curve inversion. Historically, whenever the US has a yield curve inversion, the economy crashes every single time. We made this chart ourselves, and you see, from the Great Depression, oil crisis, stagflation, recessions, to the dot-com bubble, 2008 financial crisis, and the COVID stock crash. Every single one of these periods had a US Treasury yield curve inversion. No exceptions. And look, from October 2022 all the way to January 2025, not only did we have another inversion, it lasted 27 months, breaking the all-time record. So if this indicator is really that accurate, and we just had a record-breaking inversion, doesn't that mean an economic crisis is coming? But notice, the inversion already ended in January 2025. And now it's January 2026, a 4 year later, and it seems like nothing happened. So is this time really different? Are we safe? Guys, we put serious effort into this chart, so please look carefully. In the last column of this chart, there's something called lag time. What does it mean? It means every crash takes time to unfold. It's not like the moment the US has an inversion, the economy crashes immediately. Actually, every crash happens after the inversion ends. The soonest, 9 months later. The longest, about 2 years later. This chart makes it super clear. The yellow areas below the zero line equals inversion, and the gray areas are the actual economic recessions. You'll see, every single time the gray recession zone appears about 1 to 2 years after the yellow inversion zone starts. So when the treasury inversion ends, it does not mean the crisis is over. If you believe history, it actually proves the crisis is just beginning and getting closer. This is like Russian roulette. The first 3 clicks are empty. Doesn't mean the next one is safe. In fact, the probability of hitting the bullet goes up after the safe ones, and this is just one piece of evidence. I can responsibly tell you, there are only 3 key signals, no more, and right now, all 3 have already appeared. The last one is worth as much as an apartment in Manhattan. You can all be witnesses. I'm not doing hindsight commentary after it happens. I'm saying it in advance. Catch just 1 or 2 big crises in your lifetime, and you can set up 3 generations financially. If you don't want to be a victim this time, and even wants to climb to a higher class, then you could subscribe to my channel, because I'm gonna be giving you more information like this. And if you're worried you forget everything after hearing it, and you don't want to waste your time, you can like this video, and it will be automatically saved in your playlist, so you can come back and follow it anytime. So first, why does it take 1 to 2 years after the inversion ends for the economic crisis to actually hit? Why is there this lag time? Guys, how do banks make money? Most of the time, when short-term rates are lower than long-term, banks borrow short and lend long. Simply put, we deposit money in the bank, can withdraw anytime. That's short-term deposits for the bank. So if you earn 10 million today and transfer it to your bank account, it's already short-term deposit money for the bank. The bank then lends that 10 million out for mortgages, 10 to 30 years. They might only pay you 1% interest on that deposit, but they lend it out at 5% interest. They pocket the difference. That spread is the bank's profit. This is borrowing short and lending long. But when the curve inverts, the bank has to pay you 5% on your deposit, but can only charge 4% on the mortgage loan. They are losing money on every deal. High rate borrowing plus low rate lending. The bank losing money on every transaction. Are they running a charity? If you're the bank owner, you wouldn't be okay with that, right? So banks quietly, gradually start closing the lending tap. Before, anyone could borrow. Now, only VIPs, the richest clients, the highest quality big corporations. Regular people want a house? Sorry, money's tight. Maybe wait a bit. This is called credit tightening. But it doesn't mean everyone goes bankrupt the moment banks stop lending. At first, most people don't feel it. They still have savings to spend. But over time, after a year or 2, more and more companies can't borrow working capital, can't make payroll. So they start laying people off. Laid off people lose income and become even more afraid to spend. That's why it takes time. Inversion. Banks stop lending. People can't borrow. Savings run out. No money left to live. Then the crash. Fastest 9 months. Longest 2 years. So does that mean if the Fed just cuts short-term rates, ends the inversion, everything's fine? In 2007, the Fed cut rates. Inversion ended. Then came the 2008 financial crisis. In 2019, Fed cut rates. Inversion ended. Then the 2020 crisis. Why? Look at now. The inversion ended exactly 1 year ago. But now, Americans pay 21% on credit cards. Mortgage rates over 7%. We talked about this in previous episodes. Banks are in a liquidity crisis. Even after Fed cuts, banks still don't have money to lend. If banks have no money themselves, what can they lend you? So, when you borrow, it's basically high interest territory, and that's why we've now triggered the second big crash signal. But this time, it's being hidden. What do I mean? The Fed's own economists created something called the sum rule. Simply put, whenever the blue line crosses above the dotted line, gray recession areas appear. The gray area is economic crash. So the blue above dotted will trigger the sum rule. Then the recession is coming. Zoom in. The blue line is getting closer and closer to the dotted line, but it hasn't crossed yet. So does that mean no trigger yet? No need to worry too much. True, this chart uses official US government data, but does that mean there's no problem? Guys, what does the sum rule calculate? Unemployment rate. I'll read the formula. Don't worry if you don't fully get it. It's the 3-month average unemployment rate minus the lowest 12-month average in the prior period. If the difference is over 0.5%, the sum rule triggers. Let's just look at US unemployment rates. September was 4.4%, November was 4.6%, but October, you don't know. Because no one does. October government shutdown. No one was working. Who would collect unemployment data? So, if we calculate August, September, skip October, then November, it looks like it hasn't triggered yet. That's why the blue line on the chart hasn't crossed the dotted line. But here's the issue. Missing October data doesn't mean no one lost their job in October. Of course not. If September was 4.4% and November jumped to 4.6%, what was October? Would October be better or worse than September? Look at another very reliable number. Non-farm payrolls. October lost 105,000 jobs. Biggest monthly drop since Silicon Valley Bank collapse in 2023. And government jobs alone dropped 162,000. The biggest drop in 13 years. Why? Government shutdown in October. So the government laid off tons of people. Those layoffs count toward unemployment. Wall Street estimates October unemployment was probably 0.1–0.2% higher than September. So October unemployment was likely around 4.5% to 4.6%. Sounds a bit complicated? No problem. Let's make it simple. As long as we include October at 4.5% or 4.6%, it already triggers the sum rule. You can calculate it yourself. Anything over 4.5% for October triggers it. So in reality, the US has already triggered the sum rule again, but the government shut down in October and hid the data. So on paper, it still looks like nothing's wrong. At this point, some might think this is paranoia. They don't believe data was hidden, don't believe in the lag time after inversions. But I talk about real trades almost every episode, real things that are actually happening. Can't fake that, right? Gold positioned last September, up 26% in 1 month. Silver, since last June, doubled already. Why are safe haven assets like gold and silver rising so fast and so much? Historically, very rare, but we're seeing it now and caught it. What does that mean? It means investors agree. Every crisis has a lag time. After inversion ends, we have 1 to 2 years to prepare and grow our wealth. Prepare by positioning in gold and silver. You'll notice, in this bull phase, after buying gold, silver, we mostly do nothing. Why? Because it goes up right after we buy. No stop loss triggers. The question isn't how much will I lose? It's how much more can I make? Stop profit decisions. Realize this. At this stage, it's only about earning more or less. We're at least protecting the principal. In this bull run, gold and silver have only hit our profit targets once or twice. That's why we can comfortably hold for so long. Some smart viewers might ask, wait, didn't the sum rule trigger back in July to August 2024? See, the blue line crossed the dotted line last year, and nothing major happened. Look at US stocks. When sum triggered in July-August 2024, the market dropped nearly 10%. So really nothing? Right after the trigger, in September 2024, the Fed ended rate hikes and made emergency cuts that pushed the sum signal back down. They called it a one-off, a temporary thing, because of the pandemic in 2020. Many people got fired or passed away. Plus, lots of illegal immigrants came in, taking jobs as cheap labor. That's why unemployment spiked. Okay, let's call the 2024 trigger a fluke. But now, pandemic is long over. No masks. People traveling freely. Many illegal immigrants deported. Why trigger again now? Don't believe any of this? No problem. Because there's a third piece of evidence. Wall Street giants moving their own money, big time. Look, since 2023, this blue line has plunged like a slide, meaning JP Morgan quietly withdrew deposits from the Fed. From $409 billion down to just $63 billion. What does that mean? America's biggest bank is pulling almost all its safest, most liquid emergency cash out. This isn't normal fund movement. It's like an aircraft carrier draining its last emergency fuel. So where did the money go? The red line shot up at the same time. JP Morgan put most of it into long-term US treasuries. For a whale like JPM, every big move like this is a multi-year macro bet. they're heavily betting on long bonds, meaning they expect US rates to crash hard in the coming years. Why is this evidence so important? Because bonds and rates are enemies. Rates fall, bond prices rise. But here's the issue. Fed started cutting in 2024, yet long-term treasury yields haven't fallen much. Tons of long bond buyers are still underwater. So if they're just betting on normal rate cuts, they won't make huge money. Only when rates plunge rapidly to near 0% do long bonds explode. And that's when JPM makes a killing. So when does the US slam rates to 0%? Every time rates drop fast to near 0%, black line plunges, gray recession zones appear. The gray area is the economic crisis. Last time, 2020 COVID meltdown. Before, 2008 financial crisis. Before that, 2000 dot-com bubble. So, JPM putting emergency cash all in on long bonds. Are they betting on rapid rate cuts? And rapid rate cuts only happen during economic crashes. So is JPM betting on an economic collapse. And it's getting closer? You might think this is just speculation. Then, let's look at the evidence. Back in 2019, before COVID, inversion ended, some triggered, stocks still hitting highs. Everyone saying this time different. Then, overnight repo rates spiked to 10%. What does that mean? Meaning, interbank lending rates shot to 10% high interest territory. Then stocks crashed instantly, hit circuit breakers. The Fed was forced to cut rates fast and print money to prevent total collapse. Why the bank liquidity crisis? Later investigation showed, just like now, JPM pulled $158 billion from the Fed, drained the whole banking system's liquidity, forcing the Fed to cut and print. Isn't this exactly the same as now? Blue line plunging, JPM pulling money from the Fed, right? Then, suddenly 2 US banks collapsed. Fed forced to cut rates and print buying short-term treasuries. Details in our earlier videos on the bank liquidity crisis. Banks' money is being drained again. The Fed had no choice but to step in and print, just like before. So JPM pulling money isn't just betting on long bonds. It's actually creating the liquidity crisis to force the Fed to cut and print. And it's not just JPM. Warren Buffett already sold high-risk stocks, parked money in short-term treasuries, cash equivalents. One bets rapid rate cuts. The other bets stock crash and prepares to buy the dip. Of course, some say US already cut and printed in advance, but the crisis hasn't come yet. So this time, cuts and printing will prevent the crisis. Look at the chart again. Every time black line drops first, then gray recession appears. Which means every time the Fed cuts first, and then crisis hits. So every rate cut can't prevent crises. Now, Fed cut rates. 50% chance is trying to prevent crisis. 50% chance crisis already started. Data hidden. Fed forced to rescue. And does prevention always work? History says, after big rate cuts, recession probability is 100%. But let's be generous. Say prevention succeeds 50% of the time. Then let's calculate the overall crisis probability. Simple 50% chance crisis already happening. Fed forced to save. 50% chance Fed is preventing. Of prevention attempts, 50% succeed, 50% fail. So even in the prevention case, a 25% chance crisis still happens. Total, at least a 75% chance of crisis. Of course, you can believe none of this. No problem. I'm just sharing the risks I see personally. Most important, can you make money? Is your investment strategy aligned with what you're seeing? Do you have a complete plan? Everyone's positioning can be different. If you have a better understanding in today's video, welcome brothers and sisters with different opinions. Feel free to leave a comment down below to discuss with us. If there are details in this video that you don't fully understand today, I suggest you watch my previous 2 or 3 videos because the logic is all interlinked. Due to time constraints, I have to end here. But what do you anticipate in the next episode? A lot of people are waiting for this line every week. It's gonna be a crucial one. Alright, I'll continue sharing tips on how to become wealthy, how to be an entrepreneur, an investor, and achieving financial freedom every Sunday at 8:30. If you don't want to miss out, make sure to subscribe to my channel and click the little bell and generously share this video. I sincerely wish all of you who like this video will reach financial freedom soon, as long as you can find 1 or 2 useful sentences in today's content that can help you live a better life. I'll be completely satisfied. Alright, I'll see you next week. Bye.